Hey, fellow traders. Hope everybody is doing well and starting off the new year great. This video is going to be a little bit of an addendum video to one of the series I started at the very beginning of the channel. This is basically going to be the core concepts video, kind of like a final add-on to the hedging concepts. And I'm basically just going to break down in this video the simplified way of looking at everything, so it makes it much easier to manage and make it easier to kind of understand what you're doing. So let's first go ahead and take a look at what we're normally doing with hedging on single pairs. That's normally when, for example, you're thinking the price is going to reject off of this level, so you enter and price starts to go your way, but you have your hedge order here, and then price does immediately come back up and strike your order. So that would be the basic setup for your hedge. And once you get to this point, that's when you really start to have a lot of options as far as management goes. It does tend to cost a little bit more to trade this way, but it does have its benefits. One of the ones being psychology, the other being a nature to where you have to try to find a little bit better trade. Uh, so you have to be a little bit more careful about where you're picking your reversals, because once you're actually in the process of hedging, it's much better to try to catch a reversal point in order to work with your equity and your balance. So let's go ahead and start by taking this example, and let's just say that you had uh, a double order. So you may have like a 0.02, for example, of each one, and now all of a sudden you're hedged. So let's say, for example, this was like your second round that you were hedged. It wouldn't matter if this position was down here or anywhere like that. We're just going to look at it together just for the sake of simplicity. But basically, now at this point, you're balanced fully in the market. And one thing about this situation here, and which is why I kind of suggest to check out the hybrid hedging at least, but this is going to lead into the next part of the video as well. But basically, this situation here is no different than being in this situation here where you have nothing at all in the market. The main thing about what's going on with hedging is now that all of your drawdown that you would have normally taken as a loss by just using a stop loss at this point, that is still contained right here between these two orders. So this is why a lot of times I suggest throughout the series to look at things from the point of view of basically where did the account start. So what was your starting balance? So if you had a starting balance of, let's say, for example, $200, like what I have set up on the risk calculator here in the top right. Let's say you started with that starting balance. That's going to be the focus of where you're trying to either get back to or surpass with the act of hedging. So what we're going to do in this situation, I've noticed there were quite a few concerns and kind of curiosities about, okay, so let's say if price does continue to go up and now suddenly, maybe we don't want to, we're not so confident that this is going to reverse, but it's starting to look like a little head and shoulders pattern up top. Uh, what most people would do, and this usually ends up making a position much larger if you end up being wrong in this instance, you may want to try to not apply so much risk to this position. This is also going to be kind of further detailed a little bit in the Achilles heel video. But basically, we're going to exercise video 2, I think it is, the risk versus exposure part 2 video. And this is basically where we're going to bring into account Pip Value. So Pip Value is going to be the main concern when you're actually hedging. And that's going to be the main thing that you want to worry about in this situation, because basically we've already looked at this being the same as this. But what we want to do is, if we're holding our positions in the market, for whichever reason, mainly just being it would be a preferred style to trade. So what we would have to do in this situation, though, let's say we didn't want to risk much, uh, we only wanted to risk $3 instead of $6. So we're going to use a smaller size in order to control that risk, because it's all about risk control at the end of the day. So if we were to expose ourselves for $3 of risk, it's also going to take into consideration the pip value. And basically, what pip value is going to represent is, let's say price has moved, and that was, say, 10 pips. So if we were going to use that distance to say 10 pips, and we wanted to only risk $3, so that would mean if we went back the other way and got it wrong, we would be looking at $3 of risk because of that pip value. Now, if we close out both of these orders and as the buy orders to realize both gains, which is what most hedging strategies and what most common trains of thought would be to do, and then you would immediately put these orders back above as limit orders. But then once you get hit, now you're going to incur $6 of risk instead of 3. So what the risk versus exposure and the Achilles heel part is referring to is, instead of closing the entire position, you only close out part of the position. This is going to give you a smaller amount of risk against your position. It's also going to give you a smaller and slower gain back against the other positions as well. But if you do start to get it right, you could choose to close this out and then take on the full exposure amount of both sell orders. Because when we go and close out, for example, in this situation, if we thought the market was going to continue off of this right shoulder, we would just simply close out one buy order, and that's going to be exactly the same as having a single sell order from down here, but it is going to affect your account from where you actually closed out the buy. So, basically, all that complication, if you simplify it down, this right here is all that's happening. Just a simple, it would be no different than setting a sell order, and then you would take and place a buy order, head stop, right above. So this way, if you're wrong, you're only wrong that $3 of risk that you planned for by using your pip value and your sizing. So if we were to go up and set a manual size, so if we would have exposed ourselves for both, our pip value, meaning for every pip of movement in the market, our equity would change 20 cents in that case. But if we're only partially exposing ourselves, like what we're doing in the Achilles heel part, to try to reduce our losing amounts until our loss streak breaks and we start winning again, we would want to manage down and manage smaller sizes, and also use that as a sense to basically keep the account from getting out of control with oversized positions, because eventually you will get large enough to where a swap size will be more than you can attain by what you're willing to risk, and that's going to just put you in a point of no return where that you can't come back from. So that's something to really keep in mind. It is advised at first to go ahead and add in more as as price goes against the order. But eventually you're going to get to a point where it's like, okay, you can't stand the risk anymore. Your pip value, for example, so like if you add in 4 times at 0.01, well, that full size position and you're risking 30 pips is now going to be worth $12, because you're now moving at 40 cents per pip of motion against the account. So just keep that in mind if you're trying to get some close entries to keep smaller stops. You may be able to try to risk a little bit more. So, for example, close out both of the buy orders and just take those out of the equation altogether, then you're risking 20 cents per pip against these positions if this was a 0.02, for example. So that's one of the key concepts of what the Achilles heel part was actually about. And that's one way of keeping that large account from getting even larger. Because once you're in a large amount of size of position and large, basically size that keeps going wrong, eventually that's going to blow out the account. And that's the number one thing you're always trying to avoid. I always say that proper risk management will be rewarded with profits. The way I'm actually currently trading may not be for everybody, but I'm not actually using any targets at all. I'm just taking small gains periodically when using setups that I'm pretty sure about on smaller time frames. So I'm just doing some basically scalping in a nutshell, but I'm trading to a higher time frame. So a little bit complicated, a little bit discretionary, but if that's something you're interested in, you can definitely check out some of the latest videos. But those are the two main concepts to keep in mind. Just make sure you're viewing everything from your account starting balance perspective, because everything is considered, once you get hedged, I usually say that's considered as uh, you're still holding that first trade. The first trade is not done, so now everything that happens after is used to assist that first trade. It's a bit more complicated doing it this way. It's also a lot more to keep up with. You've got higher costs, you've got double commissions, double swaps. So, if nothing else, I would advise, even if you don't switch to that way, to at least give a check out to the hybrid hedging video and see if that makes a little bit more sense for your risk and cost of trading. But this is actually a very effective way to do it. Like I say, it does have the benefits of the psychology, and it does have the added benefit of basically putting you in a position sometimes where you are forced to wait. So this will sometimes slow you down if you feel like you're trading too much, or you're getting highly involved with the action when sometimes you should be stepping back. So this method of trading really does benefit uh, the trader who really could use a little bit of help and a little bit of accountability checking, I would say, to make sure that they're looking for key things like when the market is starting to shift. You don't start trying to jump in and catch every move. You start to be more careful as you get in higher drawdown. So it's one of those things that can help you develop some of your discretionary skills without even trying to be discretionary, because you will naturally get more careful the higher the drawdown gets. So just a couple of benefits, so it's not all loss. It's not a complete waste of time. Just do keep in mind, though, it is going to be quite a bit more complicated to keep up with all this, plus the additional costs. It's also going to be something difficult to do in the United States, but if you are using USA regulated accounts, you'll just have to open two accounts. I honestly recommend Oanda because you can trade in units. You open one account for buys, one account for sells, and you can easily and quickly transfer between accounts. So there's no worries about having one account about to blow out while the other account has the profit and then have to pay transfer fees or nothing. There's no issues with that. You just hit the button and it's there. So that was one of the primary regulated accounts that I was trading with, and because I'm trading out of the USA, that's one of the few options that you really have in order to be able to hedge and trade with two-way hedging or single pair hedge techniques. So I think that's going to wrap it up there. If you're looking for a lot more details on that, just be sure to check out the Hedging 101 playlist. Those are some of my first videos, so I apologize if they're not as smooth. I was basically getting into starting to make videos. So, it's the same with everything. You get better over time. But definitely check that out from start to finish, because it's going to cover everything involved. Just make sure you keep in mind your pip value. One last thing we can actually cover real quick is a schematic. I know a couple people asked for that, so let me toss this out here real quick. So you basically only have two schematics. Let me go ahead and label that as well, and I'll timestamp these below. There's going to be two types of schematics. You're either going to have price inside, so you're going to have price come up, you're thinking it's going, now you get hedged. Now this is the first schematic. You have the price outside. It's a little too small. Okay, you have a price outside situation, and then you have a price inside situation. So those are the only things, those are really the only two core schematics. And as I kind of went over earlier in the video, it doesn't matter if these are spread out on this side or this side. This is the situation of the balance. Anytime you affect any side or the other, now you're only looking at pip value. That's why it's a little bit irrelevant as to where these positions are. It is a good practice and good idea to try to only close positions that are near break even or in a positive gain. You never really want to try to close out any that are in a heavy loss, because then that's just a loss and there was really no point in hedging to begin with, I don't think. That's just kind of my opinion and viewpoint from it. But taking a look at this, so if you have a price outside situation, what you can do is close your one in profit, like we just talked about, if you think price is going to reverse and go back down. If you think price is going to continue higher, then the only solution or option you have is either to wait, or you can add another buy position and capitalize, but it will only be represented, kind of what we looked at earlier. It will only be represented as just having a single buy order in that position right there. So that's how that would affect the account. It would be a fresh trade, but in the overall idea of hedging, that's an assistive position to this first loser here that we have going on that we're trying to correct and give another opportunity. So if we're looking for price to go higher, you would have to buy and then let it ride up and then manage that as a single trade. And then, of course, you would have to have your hedge below. Now, if we are looking for price to come back in, of course, close out this buy in a gain. The account equity will not change, but now you will start to have the pip value of the difference of whatever you're out of balance. So if you're out of balance by 0.04, if you have, like, if this was a 0.08, you closed out 0.04 of this, you left the other 0.04 here. Now you're looking to be a short 0.04. So you're working as if you were making a trade of 0.04, which will move the account at 40 cents per pip. This would be on a Euro USD example, and I have a USD account, so the pip value will naturally just be 10. This works across all pairs and accounts. So if you have a Euro account and you're trading something, for example, where it ends in Euro with the Euro account, then you would be paying 10 cents per pip per 0.01. So that's how the math would ultimately work out for that. So now if you have let's take a look at the second part, the price inside situation. The only real option here, let me see. The only real option here in this situation is to either add in another position where price is, wherever you think it's going to go. So if you're seeing this as a support level here, or a support zone, however you would like to look at it, you would have to add a long position here, the same as you would if price were to continue outside, because both of these positions in the price inside situation are in drawdown. This would be negative 15 pips, and that would be negative 15 pips, for example, if we're in the middle, which is about your strongest position to act from if you can take action. So If you were looking for it to go long, you would have to add another long position. If you were looking for it to go short, you would unfortunately have to do the same thing, add another position, or you would have to wait for price to ultimately come to a price outside situation. And this is going to be the middle divider of it. On the schematic area, this is not going to work out to stone. This may be 10 pips up here and 20 pips down here, where price is deciding to reverse. But either way, the concept is going to be the same. It's either going to be a price inside situation where you have no choice but to either wait or add. And that goes for both ways. Either it's going down or up. You would have to wait or increase your risk by adding. If you're on the outside, if price is going up, you would have to wait or add in that situation. If you think it is going to reverse, then you would actually close and trail or squeeze, as the hedge channel uh, placed it and called it. So I actually like that terminology. It's pretty good because you are squeezing that trailing stop down. So it makes a lot of logic to go with that. Now you can use that technique of squeezing or trailing however you like. I do like to use higher highs and lower lows. Every time there's a break below the low, I tend to go above the recent high that was broken of the low, and so forth for the other way. But uh, basically, these are going to be your situations and your choices. So price outside, price going up, you can either wait or add. If it's going to reverse, you can close and trail, or you can actually add more shorts and trail. That would be doing the same thing. And then if you have the price inside, you can either wait for it to go back outside, or you can add more positions in for whichever way you think it's going to go. Just make sure you add in an additional hedge protection if that's the style you're choosing to use. So that is basically the breakdown and simplification of the schematics, and it's going to be exactly the same on the sell side as the buy side of this core hedge structure. And like I say, it doesn't matter where all of these are. If this was a 0.01 here, a 0.01 here, and a 0.01 here, and this was all three of your cells down here, and what you would do in this situation if you thought the price was, for example, going to reverse in this area, you see like a double top, and now we're retesting and we're right there. You may want to close out right there, just the one, and then you would take and have a new, basically, uh, you would then have, I canceled the tool, please, and let it go. Then you would basically now have 0.02 up here. One would be active. This would be a limit order, so it wouldn't actually be active just yet. So let's represent this as your trailing order. So you would probably have your hedge limit. This would be the 0.01 that you're out of balance here. And the only one in action is this 0.01 of the overall 0.03 position. So you're exposed for 10 cents per pip in this example. And then if price comes down here, starts to reverse again, now you can take and move your trail stop down, get all this stuff out of the way here so we can work with it. And that is, that right there, that difference, if you wanted to actually realize that loss there, it would actually manipulate the account balance higher, but it would be realizing a loss, but that loss would be much smaller than this gain. And overall, that is the key to profitability, is making more than you cut out. So that is why some other techniques that you may find involved with trimming will actually work. Basically, the core idea of trimming is taking more from the market than you actually let go into the market, if you're looking at that schematic for the money flow that I've included up in this series. But that should definitely, I think, conclude everything. If there are any other questions about the playlist and all, after you've checked everything out, just be sure to leave a comment below that video or even below this one, and we can expand it a little further. I know I'm going to be doing a lot of lives on the channel here soon, mainly just trade and talk. So if you guys have questions, or if you have concerns, or if you're having a few issues that you just can't quite troubleshoot what you need to do to try to correct those and improve your overall measured numbers, because I always say if you can measure it, you can improve it. Definitely bring that question up on a live stream, or just drop it down below and I'll try to address it. In the case of this video, I'm going to include it in the playlist for Hedging 101. At the end, it'll be the addendum to try to basically be an overall summary video of what's covered in the entire series. So this right here hopefully should kind of simplify everything for what you're looking at overall, to hopefully help you solve the situation you're in, with careful planning and patience, and just keeping things in mind with your uh, Pip Value. This calculator, it's actually called the Scalper's Toolkit. On my profile, I'll include a link for that. I've tried to rename it, but I can't rename the link on the website. It's a Scalper's Toolkit uh, risk calculator. But basically, going through this, it uses the ATR, which is a common way to calculate your stops. Right now, I've got a little bug in the code. You have to leave this set in pips, and this works in points. Uh, but this would be a stop size if you were using a fixed size stop. If you're using an ATR multiple, this is a multiple of the current ATR, so you can see that changed over here. And I'll make that a little bit bigger as well. There's 5 sizes for it. Tiny works pretty good on the phone. Normal's usually good for desktop. You can set it anywhere around the screen as well, 9 different positions, and you can kind of customize the view of it a little bit. But excuse me. This will basically calculate uh, what you're looking at based on some settings out of here. You will have to agree to this before it calculates any of this, because it's one of those things where it's like, your widget said, sorry, but just one of those things you would have to understand your pair, please, before relying on this. This is mostly for a rough estimate, but it will get pretty much spot on. The only thing it does not include are commissions. I haven't coded that in yet, so that's one thing I have to go back and code into it once I make it back around to it. But let's go back to the top and carry on from there. This will be the reward ratio of your stop size. So it'll automatically give you a target as well based on your risk reward ratio. So if I was looking for, like a 1.5 to 1 off of this, doing a small scalp short term time frame, I've got the 1 minute just so it was easier to draw with. But if we were looking at a 1.2 stop, the take profit would be 1.8. I do advise being very careful about small, tiny trades like that, especially if you're a scalper, because the fees themselves can usually range between 0.6 to 1 pip in actual costs. So if you're looking at a 0.6, that would be more like a 1-to-1. In this situation, you would be a stop loss of 1 pip and a profit of 1 pip after your cost, but you would have to take the full 1.8 in order to get that to work out to be 1.2. ATR is slowed down a little bit, so it updated. This updates about 20 times a second. So it also takes live prices to get the calculations in the background. This next part, you've got where you can actually modify and change the way it looks, change the position. It has 3 different layouts. So if you don't like the way it looks, you can change everything around a little bit. I like the single column, preferably. And then 5 different sizes. So depending on what you need, if you need to see it larger, it can get extremely large. But those are unfortunately the 5 sizes that are included in PineScript. Then you have your text and your background color. Mainframe, that's going to be the draw around border. And then I have divider lines, so if you want to see lines kind of like a spreadsheet, or you can just place those to 0 and they will disappear. Same with the border as well. If you just want to have just a standard block with the information on it to keep it simple, so you can kind of customize the way it looks. This is for your account size. This is going to be the currency. Just put in the 3-letter code of the currency of your account and your symbol, and it uses all this in the calculator so it looks right. So it kind of may miss a 0 here and there too. That's one thing to keep in mind. I missed a couple of lines of code, so I have to take care of that. And then your account size, this will be for your risk calculation. It automatically calculates your risk size and your actual lot size that you should use. It does only work in lots though, unfortunately. But one 0.01 is actually 1,000 units. So you can convert it through that way just by keeping that in mind if you're trading with units, as I recommended a little bit earlier. This risk tolerance part can be a fixed dollar amount. So if you're trading with smaller accounts and you only want to risk $3, you can just type in $3 here for a fixed amount. Or you can do a percent based off the overall account size. You'll just have to come and update this as your account changes to get a new calculation out of it. This will actually tell you if the stop and the trade that you're looking to take is too much risk for what you're trying to have as a risk tolerance. So to show an example of that, I will go back to fixed size for a 30 pip and notice how it went red because the lot size is too large and the maximum risk is going to be $12 and we only want to risk 3%, which is $6. So it gives you kind of a quick heads up so you don't get absorbed in the chart, especially with scalping, and suddenly notice if you're using ATR especially, maybe the ATR may spike up and it may be too large of a movement for what you're looking for your risk, so you may need to size down in that instance, for example, or go with a bigger stop or higher tolerance. Right now, I was trying to set up some other things, but because of the math, this may not happen. It's already becoming quite large of a script, but it's for Forex only right now. Um, it has an automatic mode. So notice when I change that, we have our uh, fixed amount of risk of $6. So it automatically calculated our best size is going to be a 0.02. Keep in mind that's without commission, so you'll have to add that to the risk. Um, and if you want to figure this out manually, like for using the hedging example, like if we wanted to expose a 0.1 and we wanted to use a 30 pip hedge stop, for example, if we were just sticking with the same size hedge stop, which is a common strategy, that will tell you, okay, this situation, if we close out at 0.01 and start squeezing back a 0.01, this is what we're looking to get. And that's what we were looking to expect. So if we get it wrong and get hedged out, we'll lose $3 more of equity. So that's one way to kind of manually calculate. So if we were to close out 2 of those, for example, now we're risking $6 against our equity. So you can use this in order to calculate everything out and know exactly ahead of time with this calculator without having to use one of the sheets or trying to use the large complicated HC1 abacus. There are a couple of little bugs with that one. It was an early development, but it is fairly close. It doesn't quite work very well on the phone, but it does work best in Excel. But you can check out those videos as well. The HC1 has a video by itself because there are so many different options and things to go through on it. So if you're interested in that one, be sure to check it out. It's a full account emulator mainly. So it's a little bit of a more in-depth spreadsheet and calculator. So be sure to check that video if it's something you're interested in. But I think that is a good spot to wrap this video up. That should kind of handle and help with everything. Again, I'll leave a link for this below. You can find it on my scripts page. It's the first script that I have out of the 2 that I have on my page for profile. You can also find my TradingView profile on the channel description page. But I'll leave a link directly to this calculator if you want to grab a hold of that and start playing with that. But be sure to check the description of the video to find that, and I'll catch you on a live stream if you want to join one of those. I'll mainly be looking to do those live streams around session open times. If we're looking at a day where we might get a movement, Like tomorrow, market day, GMT is Wednesday, so I could be hopping on for the London or sometime during the New York session to try to do a little bit more scalping. So that's one thing to look forward to if you're just catching the video as it comes out. And then in order to find out when I go live, it's going to be kind of a random thing right now, but it's mainly going to be during the high volume sessions for scalping. So just be sure to check the subscription. Be sure to subscribe, sorry, and hit the bell for notifications. I'm generally going to go live, give about 20 to 30 minutes, start doing my analysis, what I'm looking for the day, so on and so forth, while people join in, and then the open and so on will be mostly trading and just talking with you guys. If you have any questions, I'll keep an eye on the chat as well, and we'll just talk back and forth and trade, have some fun with it. No stress environment, no real big deal. Risk is risk. We're just trading, so we'll trade and talk about it. Hopefully, learn a few different things, learn from each other, and see where it goes from there. But I'll catch you on the next video.